something. Is the shared functioning? Yeah.
Let's see here. Oh yes, it
Here.
looks great to me. Yep.
So I'll tell you one thing about that, the ratio charts. Look, and with a trading tool like TradingView, in a click, you could, guys, at least give yourself a chance. Whatever you want to buy, before you could buy, at least do a ratio chart versus its peers versus a few other major asset classes, just to make sure you're at least beating a few of the other ones. So that essentially, if you want to like encapsulate
Okay.
that,
Let's see
if
here.
you're winning on a ratio chart, that means you have more tailwinds than headwinds. So you have more probabilities that you'll have a sustained move if capital flows are going in your instrument versus another one, right? Because everybody's fighting for the capital flows. So that's what it also tells you. You're increasing your chances of having a more meaningful run, right? So please, guys, it takes 2 seconds. Look, this is what baffles me. Before I get into this chart, people spend more time shopping for a $200 TV screen than they do before betting 10, 20,000 on a stock. It's crazy. Oh, this guy on Twitter says
That's
that stock's
classic.
going up. It puts so much money like that. And then the guy's going to tell his wife, that TV screen's $50 too expensive. Honey, let's go shopping. It's like, it, I've done it myself, like back in the days. It makes no
It
sense,
makes no
guys.
sense.
No
Oh,
sense.
Patrick, I really want to comment on that because it is a such an interesting conversation all the time. Is exactly what you said, and there's a saying about it I've heard before as well, where someone will spend 2, 3, 4, 5 months researching a refrigerator to buy, but they hear a tip about a stock, like just on a maybe they're just standing in a sandwich shop in line, and they hear a tip, and they'll just go put their life savings in it because it has such a get rich sort of. That's the
Yes.
tip essentially. So I love that saying because it happens all too often, and it would be great if more people approach markets with the same research and carefulness that they do when they buy a refrigerator or a TV. So I'm right there with you. I love that lesson.
Well, that's why we're here, right? That's why, like, guys like me who've looked at, like, I don't know, 10,000 hours of charts, it's like, there's a reason, right? You go to the doctor, you get a specialist who studied in that's going to help you, right? You don't go to your mechanics to do open heart surgery, right? So look, if you don't want to spend the time, guys, it's fine, but always make sure at least you look at somebody who's looked at it for many, many years. Okay, let's do it. Okay, this is a major chart, which, thank goodness, again, TradingView looked at data 1914, guys. It's beautiful. It's the SPX divided by the PPI. So PPI is the producer price index. It's a proxy for inflation. It's almost like the CPI. It's the cost, the input costs for people to produce the products you eat, right, or consume. The farmer, the milk, all that stuff, the cows, the cattle feeder, all that stuff. Producer price index, but it's primarily energy. So there's a huge oil price discounted or part of that producer price index. I overlaid, and this is a trick, guys. Whenever you look at a chart, my first reflex is always look here at the top left for the indicator. So SPX divided by PPI. The time frame, these are monthly closes. And after that, look at the scale, guys. It's not always apparent, but always make sure this is the log scale, or at least understand if it's on linear. Because I'll show you an example later that people could cheat, could manipulate your bias by putting this on the linear scale. The linear scale essentially is it's going to be each distance going to represent a numerical equal amount move. But when you're on a log scale, the distance is percentage move. So over time, as they're destroying your purchasing power, etc., that ratio is at 0.33. If that was linear, and here we're at 21 today, I could practically, this would just be a flat line here at the bottom, and I wouldn't be able to do TA on it. So it's very important. Okay, this is a question there that a lot of people ask me, Patrick, should I use log or linear? Log works 100% of the time. Linear works only when the moves here haven't moved logarithmically or in order of magnitude where you're not adding digits. As soon as you see you're adding digits, right away log. In all cases, log always works. So that's to answer that question to help people. Here, moving average, I have the 84 months, so the 7-year moving average, and I have these green overlays. This guy had put an indicator, and I have all the official U.S. recessions, all the ones that were officially. And remember, guys, recessions, you got to be careful with them because they're often backfilled, right? Like the 2000 right here. Look at my mouse. 2007 recession to 2009. I think we were almost out of the recession when they backfilled it all the way to 2007 because nobody was saying we were in a recession in 2007. but officially that's how they backfilled it. So here it is, basic premise of chart trading. Here I'm above 7-year moving average, a beautiful rising trend line, three points, 3 bounces on the line makes it valid. A break on the fourth, it's meaningful. 1, 2, 3, 4, 4 touches. Here's in the 1930s, it breaks down, retest from below, and that's all. That was a depression in that moment.
Patrick, let me add a little more context to this chart, make sure I understand it too. So we are seeing the ratio between the producer price index and the S&P 500, and essentially we're seeing that over the last 100 plus years. So this is basically this is market history right here, right? This is everything.
This is the roadmap, and you'll see how this ties in later. This is the roadmap of where should I be buying speculative growth stocks, well, let's say the SPX, or should I be buying stuff that hurts when you drop in on your foot, like commodities, oil, energy, silver, gold, sugar, anything that's like commodity. That's going to tell you where the capital flows are going, because there's these macro tidal waves. They go up, they go up, they go up, they go up, and when it falls, look how many years. So adjusted for PPI, the depression, look, 1929. Even here, I'll take it when it broke down below the 7-year moving average. Look at that, 1930. I'm dragging my mouse. I'm in 1954, 55 before it breaks even. Holy Moses. Yeah. That's how many years is that? 30, 20 years, 25 years? Yeah. It's people don't understand how, look, I could hear that it was a clear breakout line. I didn't write 1, 2, 3, 4. Probably here was probably the time. In 1954 was probably the time to get in, to get that nifty 50 there, the go 60s. This was probably the move there to go long US equities in favor of anything else, to ride that move up, right? Because you'll never buy at the bottom. This is another thing. We're covering so many of the basics, or I call them exposing trading fallacies. It's kind of almost our job, Steph, to expose trading fallacies. I know there's even some traders, they don't agree with me, but a lot of traders love to buy in a base, and they love to buy bottoms. But I'll tell you something, you only know you're in a base once you break out to the upside, because that base could have just been a continuation pattern that goes even down, even lower, right? So you got to be really careful about thinking you're buying in an accumulation zone where you'll only know in hindsight. Once it breaks out, oh yeah, okay, that was an accumulation, but you don't know because it could have broken down. So that's number one. And you see here, when I think the low risk entry is in 54, the bottom is so far behind. A breakout, practically, I think it always implies that the bottom is behind you. So you need price to go up, practically 100% off bottoms, off lows, to create the momentum necessary to generate something that's going to be meaningful and more probable to ride something bigger later on, right?
Wow. So you're not a bottom picker per se. You're looking for more of a confirmational before it really gets interesting to you, or do you? Because I agree with you. Timing bottoms is, I've never timed a bottom perfectly. I've tried many times and never done it perfectly.
Yes, you'll spend a lot, because if you put a statistical probability number to it, they're low probability. They're cool when they pan out. You have bragging rights, but over long periods of time, it's like somebody not going in with a ace or king. You know those power hands in poker. It's somebody playing 7-2 offsuit, jack, whatever Daniel Negreanu likes going in with. But contrary to poker, you can't bluff your way out of a trade, right? These pros, they go in for bad trade. Okay, if it doesn't work out, they bail. I'll tell you, and again, I have a beautiful chart later on. What bottoms and tops are for are to exit a position. So I have techniques to spot tops or bottoms, or potential tops or bottoms, not to get in and hope the price goes back up, but to exit my position when everybody's getting greedy, when it's the laser eyes, when it's all that FOMO stuff that CNBC starts talking about it. That's when you get out. So tops is when to exit a long position that you entered at the base, and a bottom here is to exit your shorts. That's for me, that's what you're supposed to do with these things, because you're taking profits. So even if that thing goes down lower, it's not the end of the world. You're in the profit, right? But if you try to time a bottom and it goes lower, you've just lost one of your bullets, right?
So, and I want to say to that too, as I'm even watching your mouse go across the chart, and I realize something that we haven't even covered yet about this chart And there is the wisdom of timing bottoms and really analyzing these macro frameworks. But one thing I do realize is, whoa, this chart is very interesting, because I think now I'm also understanding what you're saying. The current market environment and the way the trend is heading in terms of the S&P 500 versus the producer price index, which is a measure of inflation, you're kind of what you're demonstrating is we might be entering a period very similar to the three other rectangles that you have on the chart,
Yes.
which all signify major market corrections that lasted not 1 year, not 2 years, not 3 years, but were 5 years, 10 years, or in the Great Depression case, 20 plus years. And
Yeah.
that's what this chart is showcasing. That, and this is why this show and bringing on people like yourself are great, is because this is why you should keep an open mind to this. You don't want to go out speculating on growth stocks if this is the type of setup that's playing out. You want to definitely take a step back and do some research. But tell us about this. This is fascinating.
Well, I'll tell you. So it's all about probability. So here I did an update on this big picture chart. Sorry, I'll just show you the update. This is a zoom in on the most recent action. When I did that post, I think the price action was it was starting to fall below here. Here I have my, I think that's, I don't even know. I think that's my 4-year moving average, but it's rising up. I have a rising trend line right now. As until you're able, SPX divided by PPI is able to overcome this wall. So what I call a wall is previous support and resistance. It's also known as pivot lines, etc. These are critical. Right now, it has to overcome this wall, retest it from above, and then that's only going to create a possible continuation breakout line, right? Just like here, it went back up, it faltered at the wall here in 2007, it fell. But this, what it creates is the next possible breakout line. So here I have 1, 2, 3, and then it breaks out, right? I could have drawn a trend line here. That's where you get in. So right now, this thing has been going sideways for now. It's lost its upwards momentum. You don't want to go into something that's lost its upwards momentum. You want to go in something that breaks out. But before it does that, I have to overcome this wall and the high likelihood that this doesn't V-shape to the moon, maybe, but the more likelihood that it's going to create some type of contraction here, lower, it's going to go down. Then we'll see if it creates an expanding descending wedge, or if it does a higher low, then maybe it's going to start coiling. But that, like you said, it's all opportunity cost, because as the SPX grinds sideways versus PPI, and I'm just going to go back to the chart, no matter what the amplitude is of its underperformance versus PPI, every single time that SPX goes sideways versus PPI, that means the energy sector is outperforming. It means the yields are outperforming. It means sugar, gold, silver, they have great times. So even if we don't get a crash, let's say they're able to destroy your purchasing power and nominally keep up the SPX by printing so much that it doesn't, how they do more and more bailouts, et cetera, to keep the SPX from going down 30, 40%. If it's underperforming if it cannot be in an uptrend versus a PPI, then there's probably other assets that are outperforming, right? And this is considering the SPX does have a basic material sector. It does have an energy sector, right? So that helps the SPX a lot. So even as bad as underperformed PPI, what happens here is at the end of a bull era on growth stocks, tech is super heavy weighted in the SPX, right? Right here, probably here. And the energy sector is probably 3-4% of the SPX. But as this grinds sideways, and what helps keep a bottom from the bottom from falling below the SPX is actually the energy sector, the basic material sectors. They are increasing in weight because they're increasing in value, and they're helping the ship stay afloat while the other sectors are underperforming.
And
So look,
I want to add
yeah,
some stats to that too for the viewers, because I just pulled up a chart myself just to do a quick analysis on percentage move, and I did think it was interesting to look at the financial crisis, the Great Financial Crisis, where I just picked a random date in 2005, and from 2005 to the bottom of the financial crisis in 2009, the S&P 500 was down 43%. But if you look at gold from that same exact
yes,
date, just give me 1 sec as I zoom back. If you look at gold from that same exact date, it was up 75%. And that's the ratio, because if you bought
Yes.
something like the S&P 500 during that time and you lost 40% when you could have bought gold, which gained 75%, your opportunity cost isn't even just the 45% you lost on the S&P 500. It's what else you could have done, which is, bought gold and gained 75%. So it's actually a much bigger loss than I think oftentimes we formulate, because we're not forgetting about, because we're forgetting about all the other things we could have done that outperformed. So
Yes.
I wanted to read that stat just to demonstrate why those ratio charts are important, and how the S&P 500 versus the producer price index can give you some insight into these really large trends. And I think that's another important thing I just want to make sure I communicate and that I also understand, and tell me your thoughts here, is these are big trends. These aren't things that play out in a day or a night. It's really thinking about the next 12 months, if not more, right?
Look, when you see somebody using monthly candles, and right away you're gonna be holding that trade practically a year, because look, one monthly candle, well, it's one candle, right? So add a year, it's 12 of them. That's not a lot, right? You'll see we have tons of examples. Let me try to get a look at this. This is, let me get, okay, well, I have one with candles, but here, okay, here's a gold divided by PPI. So this is monthly chart, guys. Look at that. A year is just one small move here, guys. It's this thing is 10 years. It's 120 candles, right? So you might not be able, there are techniques to take profits along the way. You don't have to hold through all these consolidations, but even any one of these crazy moves up, these like here during the 2000s, like you said, when the SPX was breaking down versus gold, or gold breaking out versus SPX, like that, there's periods where it just went bonkers gold, like for 1, 2, 3, 4, like for a year, month after month after month after month of white candles. That's what happens when growth stocks are not able to outperform the PPI, stuff like that, right? So really got to take that into consideration. I'll show you why it's important also. So now we've looked at the SPX versus PPI going bear market rally, going sideways. So it's still, growth stocks are not out of the woods yet. Here is initial claims, guys. And this is how it ties up to some of the macro data, right? This is not, well, I am charting macro data via the US initial claims. And that's probably what the Fed, I think, must be looking at most, because when I looked at the initial claims out of the woods since 1968, it's the black line, guys, here, guys, the black line. I said, oh man, that I've seen that pattern before. And then what I did is I overlaid the gold and miner charts, the gold and silver miners. So the ASA ETF, guys, it's a fund of gold and silver miners dating back to 1968 about 1968. It's the orange line here. And look at that. The gold and silver miners track the US initial jobless claims. So, okay, this has got to be careful. This does not mean that US initial jobless claims is causing, right, the miners to go up. But they are tracking. So now you have to say, okay, no matter whatever the reason, is it something else moving the miners? If I have two charts that are moving the same direction, no matter if I cannot discern or put a name on why it's doing it, they're both reacting to something similar in part or totally. So that gives you an edge. So right now, the miners, they love when the initial claims, jobless claims goes up, right? And I've attached a whole bunch of narratives to this. I could show you this chart right here. See, I overlaid the recession. So here is gold divided by SPX. Here's my initial claims. Okay, I'll just tie it up a little more properly. Here, my miners, but here I also put the gold versus SPX. Gold versus SPX, guys, is the Rosetta Stone of the precious metals and even the other commodities. Once gold could go up to 10 million, but if it cannot outperform SPX, silver's not going to do great. The miners aren't going to do great. They are better plays on gold's capacity to outperform growth stocks. How much of those capital flows can gold steal from SPX? And you see not every month. I know people, oh, look, if you put a correlation coefficient, it's not going to look great, but they go, the ebbs and flows, the amplitudes are different, but look, they all bottom here at the same time. You see how you could see it, Steph, right? I'm not imagining this, right? They're both
Yep. And
the ebb.
I do want to comment on the outperformance line you had. And I'm finding that to be a theme of this show that we're running, which I didn't expect, but I am enjoying a lot because it's just such an important reminder of, you mentioned about gold and the S&P 500 if they're both going up, and that to me always highlights the competitiveness of the industry because everyone is trying to outperform everyone else. And managers, if you're a money manager, if you're an institutional fund, or if you are a money manager for clients and things like that, you sort of have a duty to beat a benchmark. And oftentimes the gold standard benchmark is, are you outperforming the S&P 500? Because once again, that's the opportunity cost. You gave your money to a money manager, but you could have just bought the S&P 500. If that money manager underperforms the S&P 500, right?
That's right.
It's a bad trade for you because you could just put it in an index fund, low fees, and outperform them. So I just want to highlight that because it is a cool conversational topic that's now come a few times while listening to you. So I love that, and I just hope that a lot of listeners take that away because it's not taught very often to new traders and investors how important this ratio is or outperformance, because at the end of the day, we're all competing against each other, and there are benchmarks that you want to try to beat. So
Yeah.
I just want to highlight that because I think it's very important.
And I'm sure a lot of people are listening to this and they have, like, I'm sure maybe some fund managers, and they say, oh yeah, he's right. It's like a self-fulfilling prophecy. Like you said, they need to reallocate their capital in something else that's outperforming. And that's like a self-fulfilling thing, right? You're at the beginning of a bull era in commodities, and then they see the growth stocks are not doing well. Well, he's going to have to remove a little bit of his growth stocks. He'll have to buy a little bit more commodities. That's going to feed into the commodities going up in price, etc., until the pendulum just swings too much in one excess. You got to blow off top in commodities, and then you swing all the way back. Look here, I have that same chart, guys. SPX versus gold versus SPX, initial claims. But look, I overlaid the U.S. recessions. So this ties back in my first chart.
Oh, Patrick, this is great actually. So the green shaded areas that you have on the chart are recessions. Is that right?
Yes, yes, I
Got
love
it.
seeing that because somebody it situates you, because everybody remembers a recession, let's say of 87 or 90, or like somebody's not used to charts. It kind of it helps them situate themselves in the chart, right? Oh, of course, I remember the GFC. Look, oh, that's what was happening to the initial claims in the GFC. But what people don't see is the initial claims were already starting to move up and breaking out as that was happening. And look to the gold to SPX ratio, it sniffed it out. Everything's financialized. The hedge fund managers were already positioning themselves in gold instead of SPX as the initial claims were going up. Same thing here. Gold did a little outperformance of SPX here, a bear market rally. And look, the initial claims, they went bonkers. The recession, same thing here. It was a recession, but look at that, initial claims going up, gold bottoming versus SPX. Here, a little bear market rally for gold versus SPX, initial claims going up. 70s here, 70s here again. Rinse and repeat. So it's part of the weight of evidence. It's all stuff adding up. Look, I don't know when this is chart. I did it March 11th, May 11th. I'm watching the initial claims really close, because what's going to happen if initial claims keep going up, you're starting to do those check marks. Oh, initial claims going up, check. Has gold bottom versus SPX and moving up? Check. Is SPX continuing its downturn versus PPI? Check. And right away, you're able to situate yourself. Okay, this is what's happening. I don't need to pray and hope that my tech stocks go up. They're not in a favorable environment anymore. I got to be careful, right? Or I got to start looking at energy, uranium, whatever else that has gone bonkers during these periods. So we're really close. And this, I could have done the Fed fund rate. Most of these times, I have a chart somewhere. Most of these times when this goes up, the Fed fund rate cuts. So we could be approaching a place where, if that's going to spook the Fed, if the initial claims really, really start climbing up, we could be approaching some type of cut in the Fed fund rates.
Wow.
So
So I have to say, this is where sort of my macro nerd really comes out. And the thing I want to comment on here is that breakout line on initial claims. I've totally missed that. I did not see that happening until you've shown this on the chart, and that is a very big deal because I also want to point out, now that you're talking about the Fed funds rate, there's sort of a theme with the Federal Reserve as well, in the sense that they may, even though they have a mandate to lower inflation, there is that component
Yes.
of, if initial claims get out of hand and break out, they may not care if inflation is still high, even if it's 7%, 10, whatever. If initial claims are getting out of hand, they may be forced to break away from their mandate and cut rates. So that's very interesting about those initial claims, because I had missed that, and that is super interesting. So just wanted to point that out, because
Yes.
I do love the macroeconomy, and I can definitely nerd out to it from time to time.
Yes, you have to nerd out. So the initial claims actually are going down slightly. So right now, what I like is the more the bounce here. And guys, remember, breakout lines, they're not, yes, they are lines, but they're defined on many time frames, and they're actually zones. So you could see there's like a zone here, and this is the congestion area. And if I would have had let's say there would have been volume for this, I could have had your guy TradingView's volume profiling. So this one's meaningful right now. So the way you see it is, I'll use my squiggly line. You just wait for this to pan out. If it keeps going down, no harm done. You wait for another retest, and then after that, when this resolves, the more touches it has here, the more important it's going to be as it moves out, just like it did maybe that's not the best tool here. No, that one. So you just got to wait, guys, for these bases here to play out, right? So we're not quite there yet. So it bounced down. Let's see if it's going to do a higher low. If it does a higher low and contracts, then the next run up could be the run that creates a triggers the avalanche, right? Yeah, you're right, Steph. It's one of the mandates, right?
Inflation, in getting inflation, I think to two. No, they said I don't know. They either said 2% or 3%. Essentially, we won't stop raising rates until we see 2% inflation. It might be 3%, but it's in that range. But if initial jobless claims break out and they still don't have inflation under control, they're going to be in a tough position, in the sense of,
Yes.
right, do we cut rates to stop this breakout in jobless claims, or do we stick to our mandate of inflation, which I think is sort of like the 70s, which is like the 70s, actually. That chart you just had, the 60s and 70s, I wasn't alive during that time, but I've read about it, and it's a moment that doesn't happen often in market history, but it's very significant, right? Stagflation.
Yes. Well, let's jump. I was going through a few of my macro charts to see what question I could answer, or which one you want, but let's look at the macro from another vantage points, and why I think we're still gonna have some inflation. Here I have the United States wages 1 month data from the Bureau of Labor Statistics. It's on the log scale. So right here, United States purchasing power since 1964. Here, wages going up, and this notice how the U.S. purchasing power is an exact mirror of the wages. So essentially, if ever somebody else is getting a wage and you're not, you're losing purchasing power. Does that make sense, guys? This is the, whenever you see some unions and stuff like that, and they're getting more money, everybody's getting more money, but not you, because they're getting more money and they're chasing the same amount of goods, then by default, your purchasing power is going down. And that's what this chart proves, right? This is like, there's nobody wins by people getting paid more. They're getting paid more, but they're every time somebody gets paid more, they're just destroying your purchasing power. So everything else costs more.
No, that's fascinating. Even if you think you have this amazing wage that you're happy to stay at for life, you're going to, if everyone else is going up but you're staying flat, exactly, you actually are losing purchasing power because everyone else around you is gaining purchasing power. Fascinating. This is why I love your ratio charts, and I wish more people would do it, and this is cool to hear. I've not thought about that until you just said that.
Well, hopefully people, they know that with charts, they could answer any question they have. oh, this politician says that. Okay, let me, I have TradingView. I have 100 years of purchasing power. Let's see what they're telling me. Because I'll tell you something here. So now what is beauty here, I have rates of change. So I put a rate of change for purchasing power. And here, the black line, the bottom is a rate of change, the 7-year rate of change for wages. So this is another thing. While purchasing power forever, like I have the 100, because the wages only started in 1972, but purchasing power starts in 1903 or something like that. There, you guys have a data feed, 1913, I think it starts. So essentially, purchasing power, except for the Great Depression, is top left to bottom right. So your purchasing power, it's essentially the U.S. dollar strength versus other currencies adjusted for inflation. Bottom left, no, top left, bottom right. That means that's been the recipe, right? Because to have increasing purchasing power, you need to have deflation, right? But we've practically had no periods of deflation. We've always had inflation, and even disinflation, it's still inflation because it's above zero, right? So your purchasing power keeps getting destroyed. So here's the purchasing power in the 70s. Okay, in the 70s, purchasing power, the rate of change crashes. So while it's going down, and it just looks like it's going down slowly, it went down much faster because you see here the 7-year rate of change. It's telling you something's happening, and that's what markets react to. They don't react to just nominally, okay, there's more inflation, there's purchasing power went down. It's how fast, and the market has to adapt to that. So when you have a new cycle of destruction of purchasing power, and here, look, as destruction of purchasing power plummets, what happens to the 7-year rate of change of wages? They go up, right? They feed each other. So this environment is self-fulfilling. Purchasing power goes down faster, wages go up faster. Because wages are going up faster, purchasing power crashes, right? They're really feeding into one another here until the 1980s. And look at that, when wages still go up, but they don't go up as fast, it's a bull era for growth stocks. 1980, right, to 2000. Wasn't that the golden era of stocks? Warren Buffett made all his trillions there.
And it goes right into the dot-com bubble too.
Yes. And right here, as the wages started accelerating a little bit in the 2000s, guess what? We had the oil bull era, uranium, gold, all that. They had a little reprieve. But look at the wages now. The acceleration is as fast as it was in the 70s. Look at that thing. Purchasing power crashing at the same. Look, right now, what we're living here as inflation is kind of like everybody thinks it's done. It's a bear market rally. It's just a slowdown here. Unless this thing goes back up, and then that's okay. The evidence is telling me 7-year rate of change has bottom and is going up. For me, this is just like 1974 or something. Is purchasing power is in a downward cycle. I could have drawn a trend line here, right? There's a clear breakdown in the 7-year rate of change for purchasing power. And there's even a longer one. There's a 40-year trend line that broke down, right? There's like these massive trend line breaks across the board on all these macro charts. So when I see that, I say, okay, this is what the type of environment I'm in. And I overlaid the silver chart to give a perspective on what happens to precious metals or any commodity, because essentially what they do is, look, it's not that silver, yes, silver has its own cycles where it goes up and down, but when you zoom out, look, I'll do it live for your viewers.
And I just want to say too, on that chart, in terms of the economy, there's really nothing worse than wages going up and purchasing power going down, because I think that is one of the components of stagflation. Basically, yes, even though everyone's gaining nominally, on a relative basis, they're actually losing. And it's really hard to comprehend that or to really explain it, but it's not a great economic environment to be in. So very interesting if that's the type of situation we are entering again. And I did notice recently that, I haven't checked today, but last I checked, I was very surprised by oil's performance lately, which is related to all of this, yes, of course, and we should get to. I personally thought oil would be breaking down by now, but it's being very stubborn. But let's talk about this chart. But we should get to oil and the rest of your charts soon, because I will say, for our viewers who have stuck around, fantastic. We are approaching that 50-minute marker, and we can keep going, absolutely. But just want to make sure that everyone. We thank everyone for hanging around for this amount of time. A few people are asking about the indicators that you had on your charts. I answered those in the chats. Someone was asking about the topic of the stream, and I think they caught on fairly quickly. But let's move on, Patrick. This is great, and I do want to get to oil, because that's that chart kind of reminds me of the 70s if that keeps going up. And I won't even talk about the aspect of electric cars or oil demand, but let's continue. Okay.
I'll do this. Look, guys, 100 years of data, purchasing power, silver, forget about the manipulators, and look, and gold and oil. So the blue line's oil, log scale, silver. Look, it tracks purchasing power inversely for 100 over 100 years. The key bottoms, the key tops in purchasing power. As this, my rate of change here, you know, what's going bonkers. Silver went bonkers. Look, that's what a barrel of oil. Okay, I'll jump to the. I'll answer this your oil question right now. I have it here. Okay, here. This is the amount of fiat required to purchase a barrel of oil. The green line. I'm colorblind. Is that green, Steph?
It's green. Yep.
Okay, thank goodness. So here from 1952, that's how much oil is, because everybody says it, and now we're what, 80, that was $83. Bottom left, top right. Here's the amount of gold required to purchase a barrel of crude oil. So yes, gold was pegged all the way to the 70s, but relatively, it takes over long periods of time. It's going to cost you pretty much the same amount of gold to buy that barrel of oil, because gold doesn't change. Gold is gold. It's a piece of metal. Silver is the same thing. But if your fiat is losing purchasing power, and this is what demonstrates is, as long as they keep destroying your purchasing power, your crude oil, that commodity, will keep going up and up to reflect that change, right? Just like I'm showing you here, it's just tracking the change. I could even flip the invert scale. You see, look, I have the purchasing power now. I flipped inverse the scale. Yes, there are cycles, and with TA, you could time these ebbs and flows within the oil price. But as long as that's going up from bottom left to top right, that's where the oil price is going to go.
Fascinating. And this chart of the amount of fiat required to purchase a barrel of crude oil versus the amount of gold required to purchase a barrel of crude oil. And by fiat, it's U.S. dollars, I'm guessing, or is it a basket of currencies? U.S. dollars.
It's the U.S. dollar. So it's essentially a U.S. dollar. It's just nominally the U.S. dollar there. So it's like you want to buy it at the pump. That's how much U.S. dollars are going to be required to buy that crude oil. So again, if you measure in fiat, it goes up. But when you measure in gold or silver, that thing's just been going sideways for forever.
Yeah, that's an interesting one, I have to say. And there's no shortage of debate about the U.S. dollar being inflated, especially since the stimulus and low rates after COVID ended, and there was sort of that big boom after it, and that is going to do that to a currency. And that is interesting, because I saw the Bitcoin chart that you pulled up, and
yes,
Bitcoin's, in a similar manner, it only has a fixed amount. I don't know how you inflate Bitcoin, so it's always makes for an interesting discussion, in the fact that it has a fixed amount of Bitcoins in existence. Thus, can it lose purchasing power, or is it going to hold up versus something like the dollar? I don't know these answers, but they're fascinating to discuss on a relative basis.
The charts are going to help you answer that question. And this is the answer I give to people about the Bitcoin. There's limited supply. Well, I have some stuff here that's limited supply, and if nobody wants it, if there's less demand, even for a limited supply of something, the price is going to go down, right? There's no. It's kind of weird, that argument, because look, here I have the Bitcoin chart and I have correlation indicators. I'm comparing it to the NDX, right? One of these these black overlays here. It's a correlation versus the Nasdaq, versus Meta, versus BlackRock. When you're above 0.70, that means you have a statistically significant correlation. Look at that. Bitcoin tracks the Nasdaq, it tracks Meta, it tracks BlackRock. I could have put a whole bunch of other tech stocks there. That's what Bitcoin is. It's simply a beta play on growth stocks. So if you tie that in, forget the narratives. They're going to get you slaughtered, the narratives. Oh, Bitcoin going to go X. Look, if it's in an uptrend, and if SPX is breaking out here, here's SPX at the bottom. If SPX is breaking out, then go for Bitcoin. But right now, if ever SPX can break out and it goes in a sideways pattern for 11 years, or goes in a sideways pattern for 20 years, stay clear of Bitcoin. There's absolutely no use to be a hero and keep playing something because you think it has a beautiful narrative attached to it. It's not how the markets work. The market, you look at charts. If your chart looks like another chart, then it's like is going to have a tendency to continue looking at that like that chart. And I hear the argument that, well, it's going to not correlate. It's going to, what do they call it? Diverge, separate. There's a word that they say when something is going to diverge from the SPX. Well, okay, the day does, we'll see it on the charts. Why front run anything? It's had 11 years to stop behaving like a tech stock. So all the narratives, look, BlackRock doesn't have a halving cycle. NASDAQ doesn't have a halving cycle. Meta doesn't have a halving cycle. Why do they look the same? So you have to take a step back. Capital flows, as defined by major asset classes, fighting for that money, they're the one carving out those charts. Not the headline news, not the narratives, not the CEO of a company. Why do all these mining companies, look at, there's some terrible management in some mining companies. There's some scams, penny stock scams. Look at the altcoins. There's a whole bunch of bad stuff out there. They go up in price. If it be about the fundamentals, all these companies would not go up in price. They go up in price because money's going into growth stocks. And then after that, money's going to each sector. And it's just, it's a tsunami of cash going in that sector. And it's lifting up even the crappy stuff. They're getting a bid. So that's what's carving out markets, guys. It's kind of makes it boring a little bit, but at the end of the day, you cannot fight these trillions of dollars of hedge fund manager money or whoever, the plethora of market participants, right? Like we talked before, the aggregate of market participants have defined Bitcoin as a tech stock, not as a commodity, it behaves exactly like any other tech stock. So look, forget the ticker, guys, forget it, and just look at the chart. And you'll see, look, I have to show this chart because to help your viewers, I told them at the beginning there that you'd be able to sell close to tops. Using distance from moving average and doing some TA based on past behavior, you could see how far stretched an asset likes to go above a moving average before it starts topping out. So here I have just one sample, but I saw when I did this chart, and I put on linear scale here to manipulate the bias of people. It was done on purpose. If I would have put on log scale, it would have not looked as drastic here, right? You see how I explained before, like this data, like the move here from super low from $50 to $1,000, you know, could barely see it. But when I saw this chart here, laser eyes everywhere. No, but like speaking against Bitcoin, you were crucified. But I saw this, I said, oh my goodness, we're historically stretched from the moving average. And I did a little bit of math. And I said, look, this thing's going to overshoot above 58K. And we'll see what, that's a great, remember, enter here. We entered Bitcoin back in 2020 on the breakout. And this was a great place to take profits. And look what happened here. This is another one. Great is your tools, guys. When you publish on TradingView, guys, you get to press the play button. And all my charts, you could see all my charts, how they performed, you know. You press play and they backfill the candles. And here they put an overlay to show you exactly what happened after you put your drawing. And look at that. It went over. Yeah, sure. It's not perfect. Some wicks, but we know that was the top after that. So
Well,
just using.
Well, Patrick, let me say this on this. I have so much to say because that was I wanted to let you explain all that analysis because I know that there are crypto communities that are very set in their ways. Not saying they're wrong, not saying they're right. Just this is the first time I've really heard someone explain why Bitcoin in this example is more so categorized as a tech play as opposed to a commodity or scarce resource or something of that nature. So that I know is going to catch some people's attention. I just want to say that's very interesting. I haven't heard that angle before, but the correlations that you presented are really quite compelling, and they can't be ignored. And as a chartist, as you mentioned, you shouldn't ignore those things. You have to remove your bias to make better decisions. The other thing I have to point out too is I do want to talk about an indicator really quick because the indicator you have on this chart is so cool, and I have not used that indicator before. The distance percentage from simple moving average. I need to go try that out. So that's calculating, that's just showing you bars at each point in time, the latest price or candle closing price related to the moving average. Is that the way to think about it? That is an awesome indicator.
Yes.
I should have that all the time. What a great way to measure fear and greed or looking for a deviation from a mean price or an average price.
Yes, it's great, and I have to show this to your. I know we're running hot there, but FOMO profit, because I did this for people on Twitter. Usually we do it for our members, but I did here a gold FOMO guide. I did one for silver, guys. Here's distance from the 3-year moving average for gold. So we have a higher sampling rate. Every time it got 40% above the 3-year moving average, there were localized tops here. See tops, peaks. Look, so you have to see this as how much fuel you have in the gas tank. How much you want to buy it when it's coiled and tight and breaking out. You buy low here when nobody wants it, when it's not stretched. And then look, July 2020, everybody was talking about gold, right? And look, if somebody would have looked at that chart and said, oh, hold on, Patrick, I'm historically stretched to where previously it top gold. Look at that. That's where you say, oh, okay, I should take profits. So right now, if ever gold goes up in the bull market, whenever I get to 41%, I'm gonna exit into a possible top, trim my position size. And here's a probably blow off tops, so have more important corrections after or bear markets. So if I stretch 55% above my 3-year moving average for gold, I'm statistically, I'm compelled to respect this chart and not get greedy. It's, oh, maybe this time it's going to go 110% above. Who cares? If you got in low, you'll never have that mindset. You only have a mindset of holding on when you shouldn't, when you get in too late in the move, right? The further you get up here as this thing going above the 3-year moving average, the more you're susceptible of getting trapped because you're not happy with your profits. You don't have that Lambo. You know what I mean? You're like, so don't get trapped, guys. Use this, my FOMO guide. Use distance from moving average. You could have used this on the daily chart if you're day traders, guys. Distance from the 10-day moving average. Have fun with that. There's cycles within that. You could play that. Just have fun.
The FOMO guide is a great term, and anytime someone thinks they're going to place a trade that they aren't that they have to even think twice about for a second that they're chasing price or something in that regard, just think about the FOMO guide, and that is a cool term too. And
I should trademark that, Steph.
oh, the FOMO guide's great, and I also just going back to the Bitcoin aspect too. It's that is a discussion in itself that we should even plan at some point, because I do know that oftentimes Bitcoin and gold, for example, are compared with each other. But as the interesting angle of that point that you're bringing up earlier is actually maybe not so fast. They are different assets and maybe aren't in the same bucket, and that takes us even back to one of the themes of this show of relative comparisons, and that's knowing the assets that you're investing or trading in and where they fit in terms of the comparative nature that you're taking on. So if you're going to buy this asset but not buy this one, make sure you know at least what sector or asset class they fall into. That also, by the way, is something that maybe we've overlooked in this conversation, which is a lot of people don't even know where to begin there. How do you, and maybe this is a good way for us to sort of wrap up the show, bringing us back to the basics. How do you discover what asset class a symbol falls into, or what sector it falls into? Are you using industry worksheets or lists for that, or are you doing your own research to categorize them? Tell us a little bit about that, because this at least will give people a guide now that they've watched this whole episode to say, I want to do more ratio charts, but wait, how do I go find out what sector or asset class they fall into in the first place?
Yeah, well, there's a few ways, guys. You could even TradingView, like bottom right pane there, you get information of what sector any instrument is in there. You'll see oil, gas, whatever. But I think there's another website you could Google. There's a it's a ETF website where you put in your instrument. It tells you in which ETF that instrument belongs to. And because it's an ETF, it's a chart. So you'll be able to put that ETF. Let's say I'm looking at Apple. Apple's part of the KLK, TLK, I forget whatever the tech stock ETF. So then after that, you could do Apple in TradingView in the search box, Apple / the tech stock ETF, and you'll see the chart. If it's an uptrend, if Apple's an uptrend versus tech stocks, then you have a strong horse. It's beating its peers. If Apple's in a downtrend versus tech stocks, you should say, oh my goodness, why am I in Apple? There's probably other tech stocks doing better than me, right? So just a nuance on these racial charts. Racial charts help you answer the question, which, if I'm forcing you with a gun, hold Bitcoin or Nvidia, ratio charts are going to tell you which one to hold. Because remember, a ratio chart could be going up, but both instruments could be going down. It's just one's going down less fast than the other, right? So you got a nuance. You always have to revert to the chart itself of the instrument, overlay the instrument. Let's say you have a ratio chart, Apple versus, again, the tech stocks. Then you overlay the actual Apple chart, and you see the actual Apple chart tracks that ratio. So you know that whenever Apple outperforms tech stocks, then usually the actual Apple chart goes up, right? Man, we could do a series on this.
A whole series. I completely agree. And actually, before we head out, one thing we didn't talk about really quick was crude oil. And I do want to just hear what your initial thoughts are about crude oil at this point in time. Or sorry, we did talk about crude oil and it priced in dollars, but I wanted to get to your what you're thinking in terms of crude oil's next move. And it does bring us back to the PPI ratio charts that we were doing, because energy does make up a big part of PPI. Also, I would add that for those who've stuck around for this entire episode, when we were talking about inflation as well, I think what's really important is a big component of the way the Fed and we measure inflation is oil. I think it makes up 40% of the calculation. So when you see inflation's up, it's a big chunk of it is oil. And don't forget, if oil is also goes into input of food prices. You can't really make and produce and ship food without oil too. So it almost makes up the whole inflation index to some degree. So curious to hear what you're watching in oil before we head out of here, what the people should be thinking about, and just any other concepts or ideas that come to mind while you're charting and analyzing one of the most important energy markets out there.
You see my screen, Steph?
Yes, it's loading.
So here's a crude oil quarterly log chart. Again, this annotation, it's posted in my published charts on TradingView. So what I like doing sometimes, I take a print screen of my chart, how I did the original annotations. And look, I had this line here. There were wicks. I said, okay, it's turning. It's discovering a possible next resistance or breakout line. So then after that, you have to look downwards. Okay, where's my support? So that's how it was back over 1 year ago. These are quarterly candles, guys. So 4 of these is a year. It's like I'm going to be 60 by this thing plays out. And here it is today. It just went exactly here on the support around 73. Quarterly closes hanging around that zone. The wicks on the smaller time frames testing that longer term slanted line. 1, 2 touches here maybe. And right now, if oil is able to get out of this congestion area, it's probably, I could have drawn the line here on the smaller time frames. It's probably 80 or something. If it starts moving up, this is a target, guys. It's a reverse symmetry move. That's something we didn't talk about. It's a reverse symmetry move back to 140, guys. That's in the cards right here. And if that happens, then that's a flame on for inflation, right?
Oh, that's it. If crude oil goes back to 140, to me, we're just doing the great financial crisis all over again, because it will just have too big of an impact on the way inflation's calculated, which leads to higher interest rates. Prices are going up, but people are losing purchasing power. Oil at 140 is not a great thing at this point in time.
Well, I'll tell you one thing about that nominal, the illusion of fiat.
Yeah.
Oil at 140, even people say, Patrick, how you dare say oil is going to go to 300? Hold on. If oil is at 300, but everybody's wages doubled and gold price doubled, and then you start measuring oil in wages or oil in gold, it's sustainable. It's not as bad as people think, right? Because look in the 2000s, oil was at $20 here. And look, this is a fractal. It's practically this. Well, I can't say it's practically the same there, but this is the fractal I'm looking at, 2001 or 2, as oil was bottoming and moving up. That ties in, Steph, to my first chart, where SPX was rolling over versus PPI in the 2000s, right? As we're hitting the dot-com bubble, we're practically here. 2001, 2002. So for me, this is the roadmap. Let's see how it plays out. But you're right, like the whole inflation narrative. I love how people have given up on inflation, because as a contrarian and as the charts, if I'm hitting supports and the support's holding, man, this is getting really interesting there. Hopefully people now see the edge charting. I hope we brought them to the point to say, forget the news. look at the chart. It's telling me that something's possibly up on the corner, and I got you. You just got to prepare for it, guys. It's not 100%. It's probabilities, but it's the closest we get to us being the house. Instead of us playing a game where we're guaranteed to lose, with charts, at least now you have a chance of you having a slight edge and surviving all this nonsense without taking crazy gambles.
Patrick, that's a perfect way to end it, because that is exactly the message that I think people want to hear, and it's also good for them to hear. And on that note, we've dropped a few links to your TradingView profile in the chat. We'll be sharing this video around the web, so you can follow our TradingView account on TradingView. We're also on YouTube, TradingView, and you can find this interview there. So follow Patrick on TradingView, tradingview.com/u/badcharts. Link is in the chat. And for all of those who watch this or are hopping in late and want to know what was discussed, we covered Patrick's career in charting, including where he came from and where he is now and the company that he runs today, as well as we went into macroeconomics, the Federal Reserve. We went deep into ratio charts and why it's good for traders and investors to do more ratio charts so they understand relative performance, as well as sort of what institutional money managers are doing. They're always trying to outperform indexes, and there's an opportunity cost to everything they do. We also spoke about commodities and lots of other just little details about charting, because Patrick has 15 plus years of charting experience, so there was a lot to cover in this conversation. So Patrick, thanks so much for joining us. Thank you to all of our viewers, and we will see you on our next show.
Thanks, Steph.
See ya. If you're at your desk, commuting, or maybe even just at the beach looking to follow markets, the TradingView mobile app is the app you need. Today, we're going to show you the TradingView iOS app, but keep in mind a lot of these features will also work on the iPad app. Just head to the Apple App Store, type in